Well, hello again, everyone. Again, this is Noah McIntosh with Macintosh Associates, and here for your market update for the week. Well, a melt up continues. Markets took off again last week with the S&P 500 and Nasdaq setting new records once again. The Dow continued on the path back to 50,000, something we haven't seen since February 11th. As usual, the Iran conflict and oil prices dominated the news cycle. The price of oil is the first sign that either things are getting better or that there has been an unexpected turn which triggers markets to sell off. The latest news is that the U.S. and Iran are nearing a deal to end the hostilities. The U.S. blockade of Iran is having a significant impact, and Iran has been unable to break the blockade despite all their bluster and rage. After announcing hostilities with Iran were largely over, President Trump announced Project Freedom, which would involve U.S. warships chaperoning commercial vessels through the Strait of Hormuz. This announcement could be read as the U.S. is going to parade our ships with commercial vessels in tow under the Iranians' noses, and if they shoot at us, it will give us the excuse to ramp things back up. Whatever the objectives are or were, the operation was abruptly halted 2 days later based on a request from Pakistan and other countries, because an agreement was being evaluated for ending the conflict altogether. Oil dropped in the news and markets soared. Unfortunately, this is how things will likely be for a while. If there's a glitch in the agreement and any hint of the conflict continuing, oil will spike back up and markets will retreat. The only silver lining may be that we're at record highs and any pullback will not be meaningful given that Iran is incapable of posing any significant threat to the region anymore. So what's moving the markets besides Iran and oil? Earnings have been strong and the economy seems to be weathering the storm of any high energy prices so far. It's hard to avoid the headlines, but the market is telling us things should improve in the next few months. The other measures of economic health, inflation, and jobs have not been as bad as feared or have improved. There's real hope that markets will rip again as soon as the conflict is over. Then we will see what kind of agreement we made with Iran and what impact higher oil prices will have on the economy, if in the intermediate term. Was there lasting damage, or is this all temporary and will evaporate with lower gas prices? The reality will be somewhere in the middle, but until we can see things clearly, we'll have to choke on the smoke and be blinded by the mirrors. These conditions don't make for good decision making, so stay the course. Job market shows signs of improvement. Let's talk about jobs for a bit. Remember a few months back when there were some dire predictions about the jobs market stumbling? That hasn't come to pass so far. The March job openings and labor turnover summary report was about the same as February, 6.9 million in March versus 6.8 million in February. That number is stale because it's always delayed by a month, but it gives us a snapshot into the period where the predictions of a deteriorating jobs market were being made. The report showed up job openings weren't drying up, but remained steady, and hiring may not have been robust, but it was picking up. Then we got the ADP employment number for April last Wednesday, which came in at a very strong plus 109,000. It was looking like jobs had hit a soft spot and flattened out over the end of 2025 and first quarter of 26, only to begin a recovery as we entered into spring. ADP reported plus 62,000 new jobs in March, so based on that data point, jobs were ramping up and pay increases were outpacing inflation. On Friday, the April employment situation and the U.S. Bureau of Labor Statistics confirmed job growth is solid. Consensus expectations for plus 63,000 new jobs to be created according to those polled. In reality, there was 115,000 new jobs reported for April, almost double the estimates. The unemployment rate remained at 4.3%. Wage growth was less than expected, but is still in line with inflation. Overall, it is decent news for a jobs market that had been written off a few months ago. Well, coming this week, as has been the norm lately, Monday will be quiet to start the week. April existing home sales is the meaningful data of that day. If last week was all about jobs, then this week is all about inflation. We'll get the CPI index and core CPI for April on Tuesday. With oil and gas prices surging, expectations of both those numbers will be going up. The real question is how long can we expect to stay at these levels before they come down? Wednesday will feature the producer price index and core PPI. Costs for producers will definitely be up. So the debate here is how soon and how much will be passed on to the consumer on top of what we've already seen. We'll also get MBA mortgage applications on Wednesday. Thursday will include jobless claims, retail sales, import prices, and business inventories. And we'll end the week with the Empire State Manufacturing Survey, industrial production, capacity utilization, and home builder confidence on Friday. First quarter earnings were almost done with, and 89% of the S&P 500 companies reporting results. So far, 84% reported positive earnings per share, and 80% reported positive revenues. Earnings growth for quarter one was 27.7%, which marks the highest earnings growth for the index since the fourth quarter of 2021. For the current quarter, S&P 500 companies have issued negative guidance, while 39 have issued positive. Valuation is still historically high, with a forward 12-month price to earnings ratio at 20.1 versus 22.2 last quarter. Although this PE ratio is a little higher than the 5-year average and 10-year average, PE could jump again next quarter due to the market's recovery since the March lows. Well, that's it for your market update for this week. We'll be in your mailbox again in the soon coming week. Anything that you have questions on, please give us a call at 989-692-2200. And please check out our website at focuswealthplan.com.